a lot of, and myself included, a lot of practitioners, clients, taxpayers will look to kind of California's rules to say, okay, what are they saying? Because there's a lot published, right? And
Mm-hmm.
that can be good and that can be bad. So I think one of the things that I've had a lot through my career as a state and local tax practitioner, and I've got, I've had other people call me, or, we've been brought in certain situations to say, okay, we think we have nexus in California because we've exceeded the $500,000 rule, or we know that it's indexed for inflation. So you started out 500, it's gone up over time. But I'm not always so sure that that's really something to hang your hat on, because I feel like it's a little bit of a trap for the unwary, the doing business standard. And so I just would love to get your thoughts on that, because I feel like, if you're registered, done. Obviously, you're doing business. Or if you have these, if you meet these bright line, done, you have nexus. Or if you're just otherwise, doing business in the state. So I feel like that kind of otherwise deriving or otherwise doing business is a real trap for the unwary. So I'd just like to get your thoughts on that.
Yeah, I mean, I think you hit the nail on the head. There's three ways you're done.
Or you're just kind of done, regardless,
yeah.
Right?
Yeah, one is by virtue of qualifying with the California Secretary of State. So you're just coming, now you have filing obligation. The other is you hit the thresholds in the factor presence statute. It's 23.120. There's A and B. A is what the old school nexus, basically. And any transaction for pecuniary gain or profit in the state creates nexus. The State Board of Equalization interpreted that provision to require physical presence. Then there's B, with presence nexus statute. So you could have, property, payroll, or sales in the state exceeding the amounts. And it's almost 700,000 now. It started at 500,000. So you can have them in any of those ways. So you may have less than 500,000 or whatever the amount is of sales in California, but you sent a sales representative to California. Now you got it under A, the old school way, because there's Scripto and Tyler Pipe, these classic Supreme Court cases that say it doesn't matter if they're employees or independent contractors. If they're there to establish or maintain a market, then that's sufficient to create nexus. So, and then another thing to think about, and this is where it gets, I don't know, you're having to explain it to humans, is when you have flow-through entities. And flow-through entities, it's just, hey, you know what? We're going to flow through your California source income all the way till, not quite till you get to a person, to entities. And those count towards your sales factor number. So now, but at the end of this, you've got a person there. Say it's an S corp, or it could be an LLC. At the very end of it, it's an individual. And here's your tax bill. You have now, all these entities have nexus. Why? Because the lowest one had it. The lowest 501,000, and your share of it is 501,000 all the way through. And then the individual who is not even subject to these nexus provisions pays tax, because FTV's view, and it's in the statute, if you have California source income as a non-resident, you pay tax. It doesn't really address, hey, you might have some due process arguments for not. It just comes out and says you have California source income, you pay tax for individuals.